Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Happy Friday and good morning. Today will be the 31st of May 2024, and finally we come to the end of this month with very interesting movement that we see so far in the last 3 days across the global market. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Okay, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Authority of Singapore. All right, so before we jump straight into the short-term technical outlook of the various broad-based cross-asset classes, let's have a recap what has taken shape yesterday in terms of the key asset prices performance, cross-asset prices performance, pardon me, and its related key economic data and news. All right, so let us start with the performance of the broad-based cross-asset classes first. All right, so the performance of the broad-based cross-asset classes yesterday were rather weak in terms of the major US stock indices performance. So if you look at the major stock indices performance, 4 of them actually closed in the red. So that actually has been kind of being expressed as well in my daily dose of market insight yesterday, where I covered the short-term technical outlook on the Wall Street 30 and as well as the Nasdaq 100, where we are potentially in the midst of a retracement towards their 20-day and 50-day, 20-day moving average for the Nasdaq 100. All right, so the S&P 500 is down negative 0.6%. The Nasdaq 100 is down negative 1%. Okay, close to negative 1%, to be precise, 1.06%. The Dow Jones Industrial Average is down negative 0.86%. All right, and if you look at the heat map of the S&P 500, the primary culprit that causes the decline is actually within the mega cap technology stocks. All right, so the mega cap technology stocks, Nvidia and Microsoft, as well as Google, they are actually the worst underperformer, down negative 3.8% to negative 2.2%. All right, and what's interesting over here is if you look at the other sector and the other component stock in other sector, actually there are more greens than red. So the financial managed to gain positive. The industrial, the real estate, the energy, healthcare, and consumer defensive, all of them managed to actually have more greens than red. All right, so in fact, there are only 2 sectors that are ended in the red yesterday for the S&P 500, which is the technology and communication services. But unfortunately, because their weightage is very, very high inside the S&P 500, despite the fact that other sectors managed to close in the green, all right, at the S&P 500, it eventually in the end actually suffered a negative 0.6% decline. Okay, then there also for sure the Nasdaq 100 that has a higher weightage inside this mega cap. The mega cap technology stock has a higher weightage inside the Nasdaq 100 that actually explained Nasdaq underperformance yesterday, all right, at negative 1.06%. So what is the reason that causes this underperformance in the Nasdaq 100? Is actually due to this order by the current US administration to actually actually decided, I would say, to slow AI chip exports to Middle East, primarily singling out Nvidia and AMD. And the reason why, because the US current administration do believe that Middle East is actually the middleman to actually funnel this this shipment they get from NVIDIA and AMD, and diverted it to China. So for sure, what I did mention in my daily dose of market insight, as we are closer towards the US presidential election, which is in November, early November, as we head towards much closer to that, there will be much more campaign that is being initiated by two camps, both from the Democrat, that means Biden administration, and very likelihood potentially Trump, which is the contender to contest against Biden. Both these two camps will start to play out with lots of rhetoric against China in terms of the ongoing rivalry between within the high-tech space, that means the semiconductor and AI space. So we'll start to see this kind of rhetoric where they will start to actually enact much more we call it indirect or direct sanctions towards American chip technology or chip products towards China. And right now this is an indirect one where they actually targeted other country, and they deem that the Middle East is a friendly conduit of China, where they could actually use US technology to ship to China indirectly. So we do expect more of this rhetoric playing out. For sure, if this thing starts to get more and more pronounced, this kind of rhetoric getting more and more pronounced, it doesn't gel well for risk asset classes going forward from a longer term perspective as we head into H2. So something to be very mindful of. But definitely this is a negative news flow that impacted the movement of the US stock market yesterday in a short-term intraday basis. Okay, and another news flow I want to highlight that take shape this morning during the US. So that's more for the US side of the story, the US major stock indices side of the story. So one thing I want to highlight yesterday over here is there's also another particular news flow out from, okay, where is it? Let me highlight for you. Okay, is this yes, okay, this particular Federal Reserve official speaking. All right, so it's Fed speak. So there's this Federal Reserve official speaking called Fed Williams. So Fed Williams yesterday, he's one of the much more dovish officials. So he continued to reiterate his point of view, saying that he do expect inflation will resume easing in the second half of 2024. So with that, that actually causes the US 2-year and the 10-year Treasury yield to actually retrace yesterday, and that also give rise to the dollar strength pullback as well. So still recall in my daily dose yesterday, we also do expect from a short-term technical analysis perspective for the dollar strength to actually shape a minor pullback from a short-term intraday basis, which is actually positive for the euro dollar, the sterling dollar, the Aussie dollar, and negative for the dollar yen. So that actually indeed takes shape as well, reinforced by this rather dovish Fed speak from Fed Williams. So how does it impact the market? So if you look at the 2-year Treasury yield from here, this is the 10-year first. So the 10-year actually fall a fair bit by 6 basis points, okay, to almost retrace the prior Wednesday gain, all right, but still holding above the 20 and the 50-day moving average support at 4.5%. And the movement of the 2-year Treasury yield also inched down much lower as well yesterday. Right, but still holding above the 20-day and the 50-day moving average that's acting as support at 4.86%. So with the yesterday intraday fall in both the 2-year and the 10-year Treasury yield, we saw the dollar index failed to break above the near-term range resistance of 105.20 that we've been highlighting since 2 weeks ago. So very likely it could to churn within these two range, the upper limit at 105.20 and the all important key support level at 104.20. This green line here, which confluence with the upward sloping medium-term ascending channel that I drew from the low of 29th of December, and as well as the 200-day moving average that's I think slightly higher at this 104.20 level. Okay, so given that it managed to retrace down from the upper limit of this near-term range resistance of the US dollar index, so that actually gives rise to that dollar strength dissipating in the intraday basis yesterday. So with the dollar strength dissipating, we start to see gold remains on support above the 50-day moving average yesterday, which is also close to our short-term pivotal support that we highlighted around that 310 level. So later I'll share the short-term technical outlook chart for that. And one of the news over here is that technically speaking, it should actually support oil prices. If you look at yesterday's data, all right, so in terms of the data of the oil prices, there's this weekly EIA crude oil stockpile change for the week ending of May 24th. So the stockpile was actually greatly reduced by almost 3 times. So market is expecting only a negative stockpile drawdown of negative 1.95 million from the prior week increase of 1.825 million, but the stockpile drew down of negative 1.56 million instead. So instead of this much more drastic stockpile drawdown of negative 4.56 million. That means a reduction in US stockpile, a reduction in supply from the US side of stockpile. It should actually hold oil prices firmer. But despite this reduction in stockpile, the WTI crude oil price, the West Texas price, actually tumbled instead. All right. So if you look at yesterday's push down, it managed actually after failure to break above the 200-day moving average on Wednesday. Yesterday, it managed to push lower with a negative 0.84% performance decline. So one of the reasons why it's actually falling is due to this upcoming Plus meeting that is to be held on the 2nd of June, which is Sunday. So let me share with you, there's this little news on OPEC Plus over here. All right, so there was this news report out from this oilprice.com, so saying that sources warn of a potential OPEC Plus plot twist on this day. So what do I mean by that? So we have OPEC Plus plot twist. Bear in mind that OPEC Plus is still in mode of reducing oil supply within the cartel members. So there's over my screen over here. Let me reduce all this element. So what it means at this point in time is that the story so far is OPEC Plus members through the end of this year. That means until let me what's going on? Okay, why is it not highlighted? Okay, let me highlight this proper statement. Okay, through the end of this year, OPEC Plus members have agreed to that 3.66 million per barrel per day in cuts. Okay, so this is until the end of this year. Then there is additional supply cuts, which is plus 2.22 million per barrel per day in voluntary cuts that are separated. That means there's these two cuts. One is the 3.66% million barrel per day cuts until the end of 2024. Then additional of that, there's this 2.2 million barrels per day in voluntary cuts that is so far has been in agreement until the end of June, which is 4 more weeks from today, okay, at the close of June. All right, so in this coming Sunday OPEC Plus meeting, they were to decide this 2.2 million additional 2.2 million barrel per day additional voluntary cuts. Are they going to extend beyond June? So the consensus earlier at the start of this week is very likelihood, high chance they will extend it until beyond June. That means until end of the year. Quantum will still be the same at 2.2 millions per barrel per day. So that actually explained the earlier rally at the start of this week for oil price. But based on this plot twist, according to these two Reuters sources over here, there is an alternative option that is being discussed. That means extending the voluntary cuts for a shorter period. That means instead of extending until the end of the year, that means until December 2024, it only through September 2024. That means until only the third quarter of this year. That means that's actually explain the oil weakness prices yesterday. So instead of a longer period for until the end of 2024 December, so right now this voluntary supply output cuts of 2.2 million per barrel per day, the additional it can be extended, but only through a shorter time period until Q3. That means until September 2024 instead. So that is the plot twist. And another reason over here is that there are also two separate sources that told Reuters say that a deeper oil cut could possibly be ignited as well. All right. So right now, right, there is a lot of unclear signal coming out from this whatever unnamed sources that's being reported by Reuters. All right, that causes the oil market to be in the flix until we get the verdict out from Sunday. So with this unclear certainty, that causes the market to actually profit take ahead of this uh, key outcome that is out on Sunday on the oil markets. All right, so that actually explained the yesterday's intraday weakness in the WTI crude oil price. All right, so that is for the commodity markets over here. So now let us now move on to other key data that has been released at the start of before the start of daily dose today. Is way ahead at 7:30 a.m. Singapore time. We do have the important inflation data out from Japan. So this is the Tokyo data. So Tokyo data tends to be a leading indicator of the Japan nationwide data that will release 2 weeks later from today. So the Tokyo release ahead for the month of May. The Tokyo CPI ex food and energy, that means this is a much more important metrics that's very monitored by BOJ. It managed to recover back above 2% level. So the 2% is the BOJ target from last month week reading of 1.8% and also above forecast of 1.6. So that is actually an encouraging sign stating that the Japanese economy is not really slipping back to a deflationary mode over here. All right, so if you look at the trend, okay, there is a big uptick back to 2%. So if you look at the 5-year trend, it seems to starts to turn around after that deceleration mode since August last year. Okay, that's a turnaround. And what's interesting over here as well is that the retail sales for April, that means consumer spending for April, has also improved as well. So market is expecting only 1.9% increase from 1.1% earlier, but it managed to jump higher to 2.4% year on year. So if you look at the trend of consumer spending in April, so there's actually also a clear recovery as well. Okay, there's some signs of recovery. So with a recovery in retail sales, that is an indication that consumer spending has started to pick up in Japan. That could also lead to a firmer inflationary trend of above 2% going forward in Japan as well. So net all in all, right, that actually could see BOJ to be much more confident to actually increase a potential another round of interest rate hike going forward in the July meeting. That's higher chance odds. So that actually also drive the further weakness of dollar yen, as we could see in today's Asia session as well. So if you look at the 5-day rolling performance chart of the, where is it? Okay, let me open up the chart for you guys to see. Okay, correlation. Okay, so if we look at the 5-day rolling performance chart of the dollar, the dollar major pair, okay, we do see the dollar yen. Okay, this is the 5-day rolling performance chart. Okay, the dollar yen starts to actually, okay, give me, let it load first. Okay, so this should be 31st of, okay, let me change this date. Okay, it's a bit slower. Okay, never mind. So I can't change because it's a bit slow. I just ignore this. This is 31st of May. So this is the latest data. So what we could see over here is that this 5-day rolling performance, the dollar yen starts to actually plummet down. Now the dollar is being the second weakest performing currency against the yen at negative 0.08%. The weakest is against the Swiss franc at negative 14%. All right, so for sure, right, this is actually encouraging for the Japanese economy. Why? Because number one, a weaker Japanese yen, for sure, it doesn't really looks good. Why? Because it reduces consumer confidence, as well because of the shrinkage of the real wages. So given the fact that the Tokyo CPI data came in better than expected, the Japanese retail sales came in better than expected, that could actually most importantly increases the higher odds of BOJ being much more forceful in their normalization of their monetary policy. And do not forget over here, what the most important thing over here to highlight is the JGB yield. So if you look at the JGB yield over here, has continued to increase tremendously since the end of March, okay, which is the early part of April. So you look at the 10-year JGB yield for today, it has continued to inch upward to 1.06%, breaking above the 1% mark. Okay, that BOJ right now is no longer considered as a reference level. Previously, prior to the 19th of March BOJ monetary policy meeting, they do have that yield curve control program still in place before 19th of March this year, but stating that 1% as a reference level. Then thereafter, they removed that YCC curve control program, but BOJ, that means they totally end the YCC yield curve control program on the 10-year JGB yield, allowing market forces to detect the movement of the 10-year JGB yield. But BOJ left a little caveat stating that if the JGB yield on the 10-year starts to move up too swiftly, there could be a potential chance that BOJ will come into the market to continue to buy up more JGB bonds. But it seems to us that right now, the Bank of Japan is no longer buying bonds as aggressively as in the past to suppress the movement of the JGB yield. So what it implies of the movement of the JGB yield right now is the Bank of Japan is now letting market forces to detect the movement of the JGB yield. So what we could see is that a higher movement of the JGB yield will for sure will make the carry trade, the Japan carry trade, less attractive and more costly. That means previously market participants tend to actually have this magnet towards this carry trade, FX carry trade. That means i.e. short using Japanese yen as a funding currency to long higher yield currency. Let's say, for example, short yen, long dollar, short yen, long Aussie, short yen, long Kiwi. This is the carry trade. But this carry trade strategy will be much more costly. Why? Because of the push up in the 10-year JGB yield. Because if the yield going to push up higher and higher, and the pace remains on the uptick on the upside, that means inching up higher, carry trade will be no longer be attractive, and that could cause an unwinding of the yen funded carry trade, which eventually could see the yen strength revival coming into place, at least from a short to medium term perspective, putting further potential downside pressure on the dollar yen. All right, and not even the 10-year JGB year is spiking upwards. The 30-year JGB year as well is moving up as well. Okay, it's spiking upwards as well since the end of March, followed by the shorter term, the 2-year one, that is moving up as a faster pace, that is much more sensitive to Bank of Japan short-term overnight interest rate policy. So what is implying over here is that the movement of this 2-year JGB yield is stating that there is a much more higher odds right now that the Bank of Japan may hike again in the July meeting, based on the movement of the 2-year JGB yield that is much more sensitive to Bank of Japan overnight interest rate, overnight policy interest rate. Okay, and all this could be expressed by the derivative of their momentum indicator. So what I plot at the bottom is the 20-day rolling momentum of the 10-year JGB yield, the 20-day momentum of the 30-year JGB yield, and the 20-day momentum of the 2-year JGB yield, all of them moving up very steeply, and then the most steeply one was the 2-year JGB yield. All right, so net, all in all, what does it mean? Like I explained earlier, it means that the JPY yen carry trade carry trade using JPY as a funded currency is getting more costly and unattractive. And the next step over here, speculators could unwind this carry trade and potentially lead to a potential short-term or medium-term JPY or yen strength resurgence going forward, and that could actually be detrimental to dollar yen. That means potentially translate to short to medium term dollar yen weakness. Okay, this is the intermarket correlation share view. All right, so with that pretty much sum up what has taken shape yesterday and earlier this morning, and as well as the intermarket correlation. And one thing we'll share is that I almost forgot is today China released their PMI data as well. So right ahead, okay, before the start of, let me reduce this. Okay, good. Okay, so before the start of our daily dose at 9:30 a.m. Singapore time. Okay, why is it not showing? Okay, let me refresh again. Okay, good. So China actually released the manufacturing PMI official one for May. Okay, so it's what's going on. Okay, give me a minute now. My apologies. Hopefully, I think you guys could see my screen. Okay, so the screen is good, right? Okay, let me do a check. Yeah, I think the screen it should be good. Okay, you can see my screen. Okay, so the MBS official manufacturing PMI for China for May came in worse than expected. So it went back to the contractionary mode again at 49.5. Previously, market is expecting a continuation of a slight expansion of 50.5. However, on the positive side, the non-manufacturing PMI data, which represent the services activity in China, managed to hold above the 50 level mark. That means still in a slight expansionary mode of 51.1, but went down slightly below 51.2 for April and slightly below the expectation of 51.5. So overall, right, we see a bit of a mixed bag element from key China manufacturing data. So still indicate to us that the manufacturing activities in China still remains weak over here. So there's actually a higher likelihood that the Chinese top policymaker got to do more stimulus measures going forward to prevent the Chinese economy from slipping back into the deflationary mode. All right. So very important is we got to see next month data. Why? Because this month the China authorities, top policymaker actually announced this home buyback program from property developers. Then we got to see how does that improve the business sentiment and consumer sentiment, and that will only be seen in next month data down the line. All right. So with that, let us now straight jump to the short-term technical outlook on the various cross asset classes that I share, starting from the FX market. So we know that the dollar strength gave back yesterday. So the euro dollar actually rallied within our expectation. Still recall that yesterday we flipped to a bullish bias on the euro dollar right above the 200-day moving average and the 1.0780 level that has been met on the prior Wednesday sell off. All right. So before that, let me expand my screen. So no change, right? Still using the 1.078 as my short-term pivotal support level. Okay, first resistance has already been met yesterday at 1.0840 before it came back down, and now testing the first support level, which is around the 20-day moving average at 1.0815. All right, so for today, still maintain that short-term bullish bias on the euro dollar as long as 1.0780 is not surpassed to the downside. First resistance to watch will be slightly higher. Yesterday's swing high at 1.0845 level. Okay, above this 1.0845 potentially exposes the next near-term resistance at 1.0860 next for the euro dollar for today on an intraday basis. However, a breakdown below 1.08780 will invalidate today's intraday bullish bias basis to see a further potential slide to expose the next near-term support level at 1.0755, followed by 1.0730 next on the euro dollar. Similar on the sterling pound. So the sterling pound yesterday push up within our expectation and hit the first support area at 1.2740/1.2760 before retracing downwards. So for today, I will have a Titan key short-term pivotal support is a zone at 1.2670/1.2640, which is also the 20-day moving average, I think, as a support right now as well. So as long as at this support level holds, we will still maintain that short-term intraday bullish bias on the sterling dollar. First resistance to watch, no change, will be at this 1.2760, 1.2740, 1.2760 level. Only above 1.2760 exposes the next near-term resistance at 1.28 figure level, which is also the swing high of 28th of May. All right, this Tuesday. However, a breakdown below 1.2640 will invalidate this intraday bullish bias to kickstart another round of extension of minor corrective decline scenario towards or to expose the next near-term support at 1.2605. Below it sees 1.2540, which is also confluence with the 200-day moving average as well. So that's for the sterling dollar. The Asia Pacific currency, dollar yen. So dollar yen continues to slide as expected and hit the first support level at 1.5650, which is this green line here, before bouncing up and trading sideways for today. All right, so I don't want to put it so put any Titan key short-term pivotal resistance still remains unchanged at yesterday, 158 figure, 158.30. So as long as this 158 figure, 158.30 short-term pivotal resistance is not surpassed for today, we will still maintain that intraday short-term bearish bias on the dollar yen. Next resistance, next support level to watch after 15650 will be at this 15590, the 20-day moving average, I think, as a support, as well as the minor ascending trend line support in light green or turquoise green that I drew from the low of 3rd of May. A breakdown below 15590 potentially expose a deeper intraday slide for the dollar yen to expose the next intermediate support zone at 15430/15370, which confluence with the upward sloping 50-day moving average and as well as the minor swing low area of 16th of May. Only an hourly close above 15830 will invalidate this intraday short-term bearish bias on the dollar yen to potentially see a squeeze up to retest the long-term pivotal resistance zone of 15950/16030 that induces last month BOJ intervention to sell the dollar and buy the yen. Now, what's next for the Aussie dollar? So Aussie dollar continues to bounce within this very medium-term sideways range configuration. So no change for the Aussie dollar. We still use that 65.85 as my short-term pivotal support level to maintain that potential bounce towards the upper limit of the medium-term range symmetrical triangle range configuration. First resistance to watch 66.40. Above it exposes this week high, which is a Tuesday high at 66.80. Only an hourly close below 65.85 will potentially see the continuation of the slide towards the lower half of that medium-term symmetrical triangle range configuration. Next support to watch after 65.85 will be at 65.50, followed by 65.20, which confluence with the 200-day moving average. Okay, so that's sum up for the short-term intraday technical outlook on the FX market. So based on the respective dollar major pair that I share with you all, potentially we could see another round of intraday dollar strength setback scenario unfolding as long as those key respective pivotal levels holds that I shared with you earlier. Now, moving on will be the major stock indices. So let us start with the Asia indices, the Japan 225. So no change for the Japan 225 as it's going to trade within this range resistance of 38,460, 38,750/600. So given the fact that, in fact, let me share with you, is that a weaker yen is actually better for the Japanese, a stronger yen is better for the Japanese economy. That means a weaker dollar yen That means weaker dollar yen is better for the Japanese economy. So that actually explained to us yesterday's push up in the Japan 225 as well. So what we could see over here, we still remains this neutrality stance over here, because since it's Friday, really coming towards the close of the week, unless in the later part of during the US session, it managed to have or during the European session, it managed to have an hourly close above 38,460, then we could actually validate a potential intraday recovery to retest this weak high area where previously it failed to have a proper breakout and did that nasty slide on on this Wednesday. So the next level to watch after 38,460 will be at 38,975 level. All right, so that's for the Japan 225. The Hang Seng Index. So the Hang Seng Index continue to remain weaker given the very mixed bag performance of the the China official PMI data reading from the manufacturing and the non-manufacturing PMI data. So still no change for the Hong Kong 33 as price react negatively right at the 18,570 short-term pivotal resistance that we highlighted yesterday. So still maintain that short-term bearish bias for this ongoing minor corrective decline phase to continue to retrace the previous strong up move from 19th of April to 17th of May. All right, so yesterday first support level was made before that pullback, before that snapback took place over here at 18,240. So adjusting the levels a bit. So using yesterday's yesterday's low area, that will be my first support level to watch. Okay, at 18,155 level. So 18,155 will be my first support level to watch to maintain this short-term intraday bearish bias on the Hong Kong 33, i.e. Hang Seng Index. Below 18,155 exposes the next support area at 17,895, which also confluence with the 50% Fibo retracement of that previous rally from 19th of April all the way up to 17th of May. All right, only an hourly close above 18,570 will invalidate today's intraday short-term bearish bias to potentially see a minor recovery back up towards the 18,980 slash 19,210 intermediate resistance zone. We also confluence with the 20-day moving average, I think as a resistance as well on the lower limit at 18,980. So that's for the Hong Kong 33. European index will be the German DAX or the German 30 Bitcoin platform. So price action yesterday continued to slide down as expected, almost hit the first support, the first support level to watch at 18,320 level, which is very important. Why? Because that is actually close to the 50-day moving average, I think, as support, and as well as if I go to the daily chart, which I highlighted yesterday, is the key, very key medium term. No, I would say key medium term trend line, ascending trend line that I drew from the low of 18th of Jan that acted as a support on 14th of February and as well as 18th of April and 3rd of May, where price actually hit close to this support level and shaped that very strong bullish reversal thereafter. Okay, and what's interesting is that after prices hit this support level at close to this support at 18,320, the RSI also starts to actually shape a very strong push up as well from the oversold region and also flashing out that bullish divergence. Okay, so with this set of positive element that is taking shape on the German 30 index or the DAX right over here, we potentially could see at least a intraday short-term bullish recovery for today potentially. So for today, we will be flipping to a intraday short-term bullish bias on the German 30 index using 18,320 as my short-term pivotal support level. First resistance to watch will be yesterday's high that fails to surpass 18,530. Above it sees 18,640, which also confluence with the 20-day moving average acting as a resistance for a intraday outlook. However, a breakdown below 18,320, that means an hourly close below 18,320, will invalidate today's intraday bullish bias on the German 30 to see the continuation of this corrective decline to expose the next support at 18,175, followed by 17,000. Below it sees 17,950, which is the minor swing low of 2nd of May, right over here. That's for the German 30. US indices. So the US indices, the Dow Jones Industrial Average or the US Wall Street 30 continues to plummet yesterday and almost hit the support area that we highlighted, the first at 37,890 / 750 level. And what's interesting over here is that upon coming very close to this support area, the US Wall Street 30 also shaped a bullish divergence as well. So with this positive bullish divergence, there could be a potential intraday recovery on the US Wall Street 30 or the Dow Jones Industrial Average. So with that in mind, we'll be using 37,890 / 37,750 as my short-term pivotal support zone for today to flip to a potential short-term intraday bullish bias, with the first resistance to watch out for will be this zone at 38,415 / 550 in the first step, okay, for today. All right, so this potentially was the breakdown level, okay, that was triggered on last Wednesday. Okay, only a break above 38,550 may see a more pronounced intraday recovery to retest the 50-day moving average, also acting as a support zone area at 38 resistance zone area, or support zone area, pardon me, at 38,970 / 39,130. Only hourly close below 37,750 will invalidate this short-term intraday bullish bias to see the continuation of the corrective decline to expose the next near-term support at 37,380. A breakdown below it sees the key 200-day moving average acting as support at 36,810 level. Now, Nasdaq 100, this is the much more outperforming index because it's still holding above the 20 and the 50-day moving average. And what you could see is that yesterday's slide hit the support level that we highlighted as well at 18,470, because yesterday we flipped to a bearish bias with the first support to watch at 18,470, and this support level has been met, which is right exactly at the 20-day moving average. And what we could see over here is that the price action on the hourly RSI also shaped that bullish divergence as well, okay, indicating to us some signs of positive element that this ongoing downside momentum has started to ease off, and where the price actually rests in terms of Fibo retracement, taking into account of the last push up of 1st of May all the way up to the rally of 23rd of May. The 38% Fibo retracement is right below the 20-day moving average at 18,340 level, which is the second support that we highlighted yesterday. So with that, we'll be instead using the 18,470 as my first support level for the pivotal support for today. We'll be using 18,340 as my short-term pivotal support. So as long as 18,340 short-term pivotal support for today doesn't break down, we will flip to a potential short-term intraday bullish bias on the Nasdaq 100. First resistance to watch on an intraday basis, 18,720. Above it sees 18,830 next. Only an hourly close below 18,340 will invalidate this short-term intraday bullish bias to see the continuation of this corrective decline. We in is medium-term uptrend to expose the next near-term support at 18,100, which is also the 50-day moving average acting as support. Below it exposes 17,810, which confluence closely with the with this minor swing high area of former minor swing high area of 29th of April, which is also at 17,810 level. All right, so that's sum up for today's short-term technical outlook on the major stock indices. So with the exception of the Hong Kong 33 that still has bearish elements to see a potential intraday bearish bias unfolding, the rest of the major indices do see signs of what we call that intraday recovery taking shape potentially. All right, now spot gold. XAU/USD. Okay, so spot gold continue to hold, above the 2,327 short-term pivotal support that we highlighted, which is the 50-day moving average. I think that's support as well. Still no change, still using 2,327 as my short-term pivotal support level. And given the fact that the dollar strength may continues to extend in today's intraday session, the dollar strength setback story may continue to extend in today's intraday session. We will still maintain that ongoing short-term intraday bullish bias on spot gold XAU/USD as long as 2,327 short-term pivotal support holds. First resistance, no change, will be at 2,360. Above it exposes the next resistance at 2,382. All right, only hourly close below 2,382. Only an hourly close below 2,327, pardon me, will invalidate today's intraday short-term bullish bias on gold XAU/USD to see the continuation of the minor corrective decline to expose the next near-term support level at 2,307. Below it, sees 2,280/2,260, which is the key medium-term pivotal support zone. So that's for gold. And given the very messy price action in the West Texas crude oil that played out yesterday, which declined by negative 1.46% due to that so-called plot twist news flow that reported yesterday in that upcoming OPEC Plus decision that is due on this Sunday, I would flip to a neutrality stance on West Texas oil on the intraday basis. So neutral between 79.40 and 76.70, unless we do have a hourly close back above 79.40, then we could see at least a intraday recovery to retest this Wednesday swing high at 81 figure level. All right, so that's the outlook, short-term technical outlook for spot gold, flipping to a neutrality bias ahead of the key risk event that is taking shape on this Sunday, which is the OPEC Plus meeting. Okay, neutral between 79.40 and 76.70 for now for West Texas oil. So that's sum up for today's short-term technical outlook on the cross assets. So before we go, let's have a key look at the economic calendar. What are the data to look out for? Data to look out for today for sure will be this aggregated Eurozone preliminary inflation data, flash data for May that is out on 5 p.m. Singapore time. So market do expect further a stabilization on the core inflation rate after 8 months of deceleration to inch much higher to the 2.8% year on year for May. So that's a preliminary figure for May, slightly above 2.7% that was printed in the previous month of April. And also during the US session later, there will be this all-important core PCE price index data release as well. So that will be at 8:30 p.m. Singapore time. So right 1 hour before the start of the US stock market. All right. So for the core PCE price index, market expecting no change at 2.8% year on year, similar from the previous month of March. So that for the month of April. And during the after that, during the US session, be a quiet session. Then stretching into the weekend, we will have that all-important risk event that is more related to the oil market, which is the 2nd of June, Sunday, OPEC Plus meeting outcome, whether they want to decide how much to extend that voluntary cut. Would it be that 2.2 million per barrel, or would it much deeper cuts? And as well as the duration of the cut, will it extend as what market is expecting towards the end of the year, the additional voluntary cuts, or will it only stop at Q3 as being reported by the sources based on the news flow that I shared earlier at the start of today's daily dose session. All right, so with that in mind, I wish you all a good day ahead, and as well as a peaceful and restful weekend. And with that, thank you. This is Kelvin here signing off, and we shall speak again on next Monday. See you.